I'm just going to run through our strategy for fourth quarter. As usual, we'll do a quick review what happened in the third quarter, but that's really quick. That's like only like 2 slides. Then we'll just go through what we think is the macro backdrop, what investors should be aware of, and then we will go through with what we think is a sector and also look at the topics. So as usual, we are trying to use generative AI as much as possible so we don't become obsolete. So we were trying to, because our title of our report was the next comes the fiscal hangover. So for those who don't know, fiscal means what happens after the huge deficit spending, the huge spending by the US government. So that comes the hangover. So what I did was, the picture used to be really clear, but now it's a bit blurred. But what I typed was like bulls having a hangover, holding cash in their hand and cash. So like after so much money thrown by the government, we think, especially in 2024, there'll be a hangover and weakness in the US economy. Next slide. So as typical, we have our disclaimer. First line is this for educational purposes. Second line, second paragraph, we rely on public information. Third is that this is for general circulation, may not meet your financial needs, and please seek advice from your financial advisor. Okay, next slide. Okay, so first we'll just go through what happened, at least for the Singapore market and some asset classes in the third quarter. As the title suggests, in Singapore was really the bulls were sleeping and the bears also were sleeping. Because the Singapore market, nothing in the third quarter, although there's a lot of news up and down, but in the end, Singapore in Sing dollar terms was about flat, about up 0.4%. So basically, everyone was sleeping. So that's why we had this picture here. Okay, next slide. Okay, so in terms of in terms of what were the stock performance, so just focus on what stocks, how did the stocks perform, especially the large cap stocks. So firstly, of course, the banks. So if you look at our Singapore index, 40% of the index is all about the banks. So you want to buy Singapore's all the banks. So we wanted to look at how did the banks perform. So you can see that DBS recovered. Actually, year to date, DBS is flat. So again, it did nothing. But if you add in the dividends, so DBS actually paid $1.80 of dividends. That includes a special dividend of 50 cents. But these days, special is not very special because after you pay 50 cents, the share price dropped 50 cents. So I don't know why they want to pay. I think they're probably rethinking the idea of doing special and probably pay out ordinary because the price will just adjust. So it's no longer special. The best performing bank is actually OCBC. I think it's up 5%. Then you add another 5% dividend, so you probably get like 10% return. On your right, sorry, the best performers are actually Yangzijiang, Seatrium. So why are they performing so well is that of record order books. So these are shipyards. So they build ships. It's not like everybody wanted to start to sail and so forth, but it's mainly because there's a trend now to do more renewable vessels. So like Seatrium, of course, they benefit, oil price is up. Then they have a bonus now because now there are more and more renewable vessels being built for renewable wind farms. So they're going to get this extra boost in order book, which they never got during when the oil prices were up. Likewise for Yangzijiang, we thought the container shipping cycle was dead and buried, but now their orders, I think Peggy will highlight more if you have questions. If you order a ship from them now, it's even longer than if you try and get a GPU. So it's like 2026, I think, or 2027. Then you can, if you order now, that's the only years that you're going to get the vessels. The REITs rebounded, okay, but maybe not the last few days, but the REITs did rebound in the third quarter. And the worst performance was venture. Venture was mainly because it also, the results was bad, the outlook is bad. So they got kicked 3 times, the results was bad, then they got kicked second time, they gave a bad outlook, and then they got the final kick, the final send that was kicked in their face was that they got kicked out from the MSCI Asia Index. Then Mapletree because of the whole negativity over China. Fraser Logistics, I'm still trying to figure out why they performed so badly. So hopefully nobody asked me that. Next slide. So this is just my last time on review. So we like to also have a look at all the various asset classes, gold, bonds in general. So on the left is Singapore. This is all US dollar, so it's easier to measure. At least if you are a regional fund manager, you want to look at it from US dollar terms. So Singapore again was down about 1%. REITs, that's why, as the title suggests, the interest rate sensitive were the worst performers. Actually, the underperformance for REITs, you see the 7%. Actually, a lot of it came from just this last 1 month alone. because of the Federal Reserve said that they want to keep interest rates higher. So as a result of that, for longer, I think you probably tired of hearing that, but because of that, the whole market got repriced, especially interest rate sensitive ones, and also the bonds ETF. So bonds also were the worst performers for the third quarter. The best performers was, of course, commodities, with the rebound in oil price. In general, the blue bar here you see is for the year to date, that means for 2023 up to September, who has been the best performer. So US has been the best performer, and Singapore, okay, not the best performer. Okay, yeah, next slide, quickly. Okay, so I'll just move on to the macro themes. So the macro themes is not like we're trying to forecast where GDP is going, but we're just trying to help investors be aware of what is the current situation out there, at least the way we read the macro. Oh, okay, so the first theme is the fiscal and credit boom. So fiscal basically means government spending. I don't know why they created this term, but it basically means the fiscal position deficit. And these were the two reasons why the US economy, despite everyone forecasting a recession in the US, I didn't forecast because mine was 40% probability, 60%. So I had 60-40 that they, not 50-50 because people would think it's a guess, but I had 60% probability that we are a recession and 40. So I'm also quite right because I'm 40%. So one of the main reason why the US economy has done so well is mainly because of this chart. I know it's a very complicated chart, but the blue line is the percentage of GDP, but the main one is the red bar here. Or if you want, you can just look at the figures in the middle. So what it tells you is that the deficit, that means what the government is spending more than they collected, is almost 2 trillion. And this is 1 trillion, you can see compared to a year ago, is 1 trillion more than last year. So why the US economy has been doing so well is because the government has spent 1 trillion more than before. Of course, you spend 1 trillion, of course, it's going to be fun. Everybody's going to have fun. Whereas if you can see the red line, so it's a bit hard to see, but we wanted to track it all the way to global financial crisis. So they spent even more than the global financial crisis. But of course, as a percentage of GDP is less. So, and this is very strange, because you're supposed to have full employment, but even with full employment, the economy is supposed to be robust. The government is still spending a lot. So these days, if you want to forecast how the US economy is performing, you can just look at how the government is spending. Just to digress a little bit, I think the US market was up yesterday because of very strong jobs data. If you look at the numbers carefully, almost 40% of it comes from government or government-related jobs. So like 20% is from government, then another 20% is education and healthcare. So again, the government is really the ones that's pushing hard for the US economy, and that's why you see things better than investors' expectations. But we'll dwell on it later. Next slide. So of course, the other one is also credit card. So there are a few ways to read it. So you'll notice that when the pandemic happened, the government, there's a lot of stimulus, right? Everyone's getting like $2,000-$3,000 checks. Then of course, they don't need to use the credit card and they have a lot of savings. But right now, the credit card spending in the US is up to 1 trillion. So there are many ways to read it. Obviously, the one way to read it is that this is the last resort. I mean, consumers will only use credit card if they have no choice. So it's also a reflection that the consumers in the US balance sheet is very stretched. So it also makes us worried because how much more can you push? Because you're already pushing like additional 100 billion. So this makes us worry of the strength, the quality of the US economy's growth. So this is historical. So this is what's happening. So in general, government spending and US consumers borrowing credit card, that's one of the main boosts for the US economy. Next slide. So as we enter 2024, we are very worried that we'll get a slowdown. For us, we think there's almost a definitely that the US is going to slow down in 2024. So that's why we are very defensive in our strategy. So there are multiple tracks to growth. So let me just go through a few. First, okay, these are the most complicated. It took me like 3 hours just to go and do this thing. I do not know why. But so this is a San Francisco Fed. So one way to read this is that this is a monthly. So every month, the US consumers or households will save like 100 billion, 100 billion, 100 billion. Then when the pandemic happened, when the US government threw a lot of money to everyone, they were saving as much as 500 billion a month. Then that line that you see is that the normal spending that you actually put. So what it just shows is that because of the pandemic, the US consumer had almost 2.1 trillion of excess savings in the balance sheet. So that's why even though we thought things were slowing down, but the consumer again was still so strong, spending so strong, was because they had a lot. But most of it is coming down. And of course, the San Francisco Fed thinks that by the end of this year, most of these savings, the 2.1 trillion that the US consumer had, is going to wind down. So this will be a drag in 2024. We have our own forecast, of course, nobody wants to listen, but any other forecast is supposed to be earlier. But the key point here is that all this pandemic savings that they had is being used up. So how you read this chart is that on top, they were saving more. Then the most recent years, they were only saving like 20, 30 billion a month because they have so much savings. So whatever income they had, they spend more than they save because they have savings. But they're starting to wind down right now because then they have to push out savings and then the consumption will come down. Next slide. The next reason why, okay, this is a bit more nuanced to the US. So in the US, they got such a thing called Social Security. So one data is that for most, every 9 in 10 US citizens, that means 90% of US citizens above 65 do get Social Security for the retirement. Of course, provided is you actually contribute, but assuming that, so it's like a retirement benefit. So why we like to look at this is because these are cash handouts. So if you give me, and that's my only source of income, the propensity to spend is higher. So you'll notice the last 2 years, the US also has been boosted up because of this COLA. COLA means cost of living adjustments. So actually the US government is very sweet because inflation high, then I'll give you an 8% increase in your Social Security. Of course, we don't get it in here, no? But anyway, there's only Coca-Cola here, we don't have a cola, so the last 2 years, they will give you, if you are a retiree, because inflation is up, they give you, I think, 8% last year, then 2 years, they got like 7, 8%. But this year is going to come down to 3%. So what it means is that the amount of money given to the retirees is going to come down. There won't be so much. So again, this is like 100 billion drag. So move on to the next one. So the next one is, of course, student debt. I think this is more familiar. I think most of you know. But in the US, also very sweet. The government says don't have to pay student debt. So of course, everyone will party. If I'm a student, I also go wild. But from 1st October, you have to pay. My numbers here is a bit exaggerated because they actually give you another 1 year grace period. But just to exaggerate things, this is like another 180 billion of drag for the US consumer. It doesn't mean that the US economy is going to collapse, but what it means is that the growth is going to slow much faster than we think or what the market expects. Let's move on, next one. Okay, that's not to be so bearish, but again, there's another fourth reason. Of course, we all know interest rates. Interest rates will continue to be a drag, but if you measure in real interest rates, of course, nobody really cares if interest rate high or, but what it means, real interest rates, is that inflation means in a way is that your wage can pay off the high interest rates, but real means the rate line is the highest in 15 years. So you continue to see this high interest rates to be a drag, another drag to the US economy. So this is the fourth reason. Actually got a lot more, but let's cut down to 5. So the fifth reason is China. So China in general, every year different, but in terms of course, there's so much media attacking China, but don't forget, China accounts for almost 1/3 of global growth. That means assuming the global economy grows, let's say 3% roughly, China usually accounts for 1%, 1/3 of the growth comes from China. So be careful what you wish for. So if you want China to slow down, it's going to hurt the whole global economy. So this is another reason why we think. So just to give an update, I mean, we probably usually get questions on what's happening in China. We're not experts, but we just share with you what we think. The reason you see the words here and not the other reports is because these are important points, and also because I can't remember so many points in every slide. But mainly because, number one, there's a cyclical slowdown now in China because the export sector is very weak. And more important is that if you look at the Chinese numbers, consumption is fine. So the private sector is consuming, but they're not investing. Of course, the COVID trauma is one of it. And secondly, with the crackdown of the internet companies in 2020, so I mean, if you're a private company in China, the confidence, especially in investing, is hurt very badly. So the numbers why China is badly because the private sector is not investing. And of course, the third is the property overhang, which could last for a few years. Next slide. So in terms of, this chart, no, not trying to confuse everyone here, but this is the amount of properties. So the main one is, of course, in red. So if you look at this red line, in China at the peak, they used to sell like 15 million homes a year. Of course, it used to be only, I don't know, 11 million, but right now it is down like 30-40% to around 9 million homes per year. We think it should, the most sustainable number is 7 million. Because what we look at is household formation, marriages. So basically, in conclusion, what this chart just shows that the weakness in China we think can persist because why is property so important? It's not because you just sell home. Of course, property is important, number one, because it's a collateral. Now in China, all the banks only take property as collateral because there's no other asset. They don't really have much in equity. And number two, there's a downstream and upstream effect for property. So when property is weak, it affects the upstream, you affect copper, you affect all the building with cement. So the impact to it could be like almost 20-30% of the economy. Then of course there's downstream. When there's no property sales, there's no electronic sales, there's no furniture. So the property market has huge repercussions across the whole Chinese economy. So we think this is one headwind that could last for next couple of years because we think it still needs to stabilize at maybe around the 7 million homes per year, which is still a lot. Next slide. Because the marriages is only 8 million, but they have like 9 million of homes, so I'm not sure where that comes from. So the other thing, okay, so my last slide for the economy is, so how deep will the US economy be? Like, will we get like a 2008 global financial crisis? We don't think it will, but it all depends on this chart. So it all depends how bad the bad debt cycle will happen in the US. Not like us in 2016 in Singapore, DBS and all the banks that this bad debt, right? That means cannot collect from all the oil and gas companies. So this one so far is still fine. So far the US bad debt situation isn't really stressed out. It's nothing like what you see in 2008, 2009. So it's still stable. So, but this is something to monitor. So we might get a sharp slowdown even in the recession in the US, but how deep it is, depending whether there's a lot of bad debt. So that one we can't tell right now because the numbers don't show it. Next slide. So just two more teams, then we'll go. One more team, then we'll talk about Singapore. So for the third team, we still think there's going to be a rate cut but most likely in the fourth quarter. So if you ask me why the markets has been really weak, why bonds have been weak and so forth, it's mainly because of this chart. So this is the blue line is where interest rates are going to be. So these are all the futures market. This is where the market is not my prediction, because mine is probably wrong, but this is where the market is predicting interest rates. So right now, interest rates is about 5.2, 5.5. So it's around 5.4 because it's the actual effective rate. So by December, the market thinks there's going to be 3 rate cuts. So you can see from here, so the market doesn't expect any rate hike in November. We still don't think so. And then they expect 3 rate cuts from the second quarter onwards. Then, but you notice the red line. So the red line is in June. June. So in June, this was where the market thought interest rates would be. But right now, the market had to, because of the recent Federal Reserve meeting, the market repriced all the assets, so all the bonds, everything by 50 basis points. You see the December 25. So this is where the Federal Reserve was thought that interest rates would be in June. Then they decided they think it's going to go up to 3.9. So because of that, what it means is that interest rates, according to the Fed, is going to be higher for longer, and that's why the bond markets got hit. Of course, there are other reasons when you have 2 trillion of deficit. But this is why all the assets got hit, the equities get hit, and also bonds get hit, because the market is repricing the higher interest rate by 50 basis points. I mean, if you want to know about it. Next slide. But we are still confident that inflation is going to come down, because when we look at the recent numbers in the US, the core inflation, which is what the Fed likes to use, which is the red line, their target is the green line. That's where they'll pop champagne and say we achieved the target. So right now, the rate is 3.9. But when you look at the trend line where inflation is heading, we think it could actually hit the target by middle of next year. So that's why to us, fixed income products look interesting, mainly because of this chart. So because we think inflation could come down, and the tough one is the housing inflation, because housing is a lag. Because when you go into a tenancy agreement, it takes like 1 year to renew. So that reflects in the inflation numbers for a very long time. But that's why we think inflation is going to trend down, and that's why interest rate sensitive products or assets can recover, because if inflation starts to come down faster. But there was no news of this. Most of the news was just bonds higher. So that's why. But the real data to watch is actually the core inflation. Okay, next slide. Okay, so anyway, that's US. So anyway, you can forget all about US. So let's talk about Singapore. It's more interesting. So for Singapore, cyclically is weak. So our exports is weak. But structurally, the Singapore economy is actually really strong. Being objective about it, okay, I look at the data, not because Singaporeans so on. So the first thing is that our population number actually was, we had a record growth in population in up to June 2023, because that's how they measure. So what I say really is, our fertility rate is so low. So it's not because the fertility rate suddenly jumped overnight for whatever reason, but it's mainly because there was an influx of non-residents, but even the resident population was also a record number in absolute terms. So this is important. So this is important for the whole Singapore economy. When you have more people, then land transport can go, then people don't have to keep asking me about ComfortDelgro because there's now more passengers they can carry. Supermarkets will also do well because there's more population. Then rental homes these are more like your LHA and all that, they can, because there's more people staying in Singapore. The red lines you see here, which I show quite often, this is the actual number. So as of June, the population in Singapore now is not as we speak now, I'm just talking about June, let's checking the time, as it's 5.9 million. So we had a growth of almost 281,000. This is a record number, and 5% is really strong. So imagine if you're a Sheng Siong, if you are a Sheng Siong strategist, you'll be thinking I should get at least 5% growth in my sales because I got such a huge jump in population. Because, well, of course, some of them might be foreign workers and so on. But so these are very good numbers for the economy. The red line you see, if you can remember, there's this white paper. We had the low case by 2030 and the high case. The authorities have mentioned they are planning infrastructure for 6.9 million, but that's not their target. They say they won't achieve it, but anyway. But even then, we think there could still be some growth, further growth in population, because we're still below the low case, which is 6.5. So if you trendline it, we should be actually 6 million now. So structurally, that's strong. When you have population, then there's GDP growth. Next slide. Of course, in Singapore, I'm not talking about the 2.8 billion, but there are other foreign reserves coming into Singapore. So our reserves right now is about 500 billion. Officially, the reserves is actually the blue line. The reserves right now, if you on US dollars, about 300 plus billion. But because a large part of it, almost 180 billion was transferred out to GIC. So if you add that back, Singapore reserve is like all-time high, about 500 billion. Pre-pandemic, our reserves was 300 billion. So there's a lot of liquidity. Maybe 2-3 years later, 2.8 might leave the country, but at least we still have like a lot to hang over to about the 500 billion. Next slide. So another reason why Singapore is being structurally strong is because we have record FDI, foreign direct investments. Don't ask me what's inside these numbers because it's very hard to get, very difficult they don't disclose what this is, but in terms of foreign direct investments coming into the country, it's still a record high. As you can see, like it's about 130 billion, the blue line. We are multiple times the ASEAN 5 countries. You combine them all, they're probably like 50, 60. So we are still drawing a lot of liquidity and a lot of investments. So what it means is going to be good for the country, because investments means growth, and you want investments because it is the foundation for future growth. So that's another reason why structurally Singapore is still strong. Next slide. And one of the reasons, of course, investors come to Singapore, not because it's like a F1 pit stop, you just hang out here to rest and then you leave, but because of the strength of the country. We are the only Asian country that has a AAA rated sovereign debt. There's a typo here, it's not Moody's, it's Fitch. But if you look at of course, you'll notice why our debt is so high, although, but it's mainly because most of the debt that the government takes is more for bond repricing, because technically we don't have a deficit on paper because we are supposed to balance the budget every year, apart from COVID, of course. So you'll notice that of the 9 AAA rated countries, sovereign debt, so AAA means when you hear things like Moody's, S&P, when they rate the countries, I know like who are the best countries, balance sheet, whatever. So Singapore is the only one in Asia. So that's why we have that safety, and that is the basis for, I guess, the strength of our Singapore dollar. So among the 9 countries that's AAA rated by Fitch, I guess Fitch since it just downgraded US. So of the 9, actually Singapore is the one only in Asia, and you will notice that the debt to GDP, I guess one way to measure how good the country's balance sheet is, you'll notice that even the ASEAN countries, it should be there somewhere. The ASEAN countries it's even lower than the US debt, but of course because of currency and so forth. But it's just to show you that one of the this is another reason why structurally Singapore is still strong. Next slide. But of course, the problem is cyclically is going to be weak because we are so dependent on exports. We have the largest exports to GDP, I think like 400% or more. So exports are still down. There's a little bit of recovery. So we think fourth quarter might have some recovery because there's a bit of a inventory replenishment. But demand is inventory or consumption, but we are quite negative that consumption isn't strong. So that's why we think that the weakness will still be there, but it's mainly cyclical and structurally the economy is strong. Next slide. So I mean, this is just sales. I mean, we always get Sing-Song questions. So you want to know how the supermarket sales is, just look at the blue line. So we did very well. So of course, pandemic time, supermarket sales did exceptionally well. All of us rushed and to stock up on stuff. Then right now it's just trending, but it's still above the pre-pandemic trend, which is about 1%. Hopefully it can recover. Then it just shows that the economy is better than the pre-pandemic, especially when we have inflation. The numbers should actually be better. Next slide. But one strength that's coming for Singapore is tourism, which I think Darren will highlight more. But our latest numbers, even though we had a reopening, as you all know, on April of last year, but the numbers are still very strong, and this is even before F1. So you notice that I think this August number. So we had 1.3 million of arrivals compared to 700,000 a year ago. About 200,000 of it comes from China. Whereas if you compare to a year ago, there's probably hardly any. So China arrivals are coming in very strongly. They are like, I don't know, 10 times higher than a year ago. And we are still far from pre-pandemic. So that's why we think tourism is or hospitality is one of the strengths cyclically that's helping the Singapore economy. Especially, we see a lot of, the numbers show that the arrivals from China is exceptionally strong, about 200,000. A year ago, it was probably like 10,000. Next slide. Okay, so this is the valuation. So those who have never attended my slide, so this is a good time because I will show this, but it doesn't really, nobody cares because the valuation always go down. So even if you are new to us, so this is a good time because valuation is cheap. But if you've been, so just keep on watching this chart. So these are valuations of Singapore market, the PE. Standard deviation is just a fancy term, normal distribution, but basically you can see it's at the lower quartile, and usually when it's at this type of valuations, it tends to spike up. Either the share price go up or the earnings come down. So we're hoping that the share price go up rather than the earnings come down. That's why the PE expands. But the valuations are still attractive. But just again, Singapore, it's not just valuations, about the catalyst. So for us, the valuations are attractive right now at least. Next slide. Okay, I'm going to hand over to Zain. He'll just run through on the technicals, and then we'll go through the Singapore sector.
Thanks, Paul. Hi, everyone. Good morning. I'm Zain. So I'll be covering the technicals for Singapore market. Okay, let's get in. So for Singapore market, I'll be using this ES3 ETF, which actually tracks the Singapore equities. So this is actually the weekly chart. We can see, as Paul has mentioned, in third quarter, we didn't really do much. We are still actually just consolidating over here for much of this part. So technically wise, we are still in this rising wedge pattern, which is usually a bearish pattern. So, but currently we are still sitting at the support of this uptrend support line over here. So we could still move sideways in fourth quarter, but there's tendency for possible bearish downside if we do have a breakdown. Given that momentum has been slowing, if you look at some of the momentum indicators like your MACD. Yeah, so if you do happen to have a breakdown over here, we could expect maybe like a 3% drawdown towards a retest of like 3.13, which was the lows in July of this year. Yeah, so for fourth quarter, we could be still stuck in the range between like 3.15 to 3.3. Okay, then for our large cap pick, for this quarter, we have OCBC. So despite the sell down in the market recently, OCBC has held up pretty well. When we look at both in terms of the long-term chart as well as the short-term one, it flashes some bullish signals. So for the longer term, it still remains in this main uptrend channel over here. You can see in the chart. In terms of the shorter term wise, it's still consolidating for now. We have an ascending triangle over here with an uptrend support line. Price has been forming higher lows towards the resistance at 1290. So there's a good chance that if we see a breakout of 1290, potentially I think we could see a higher high being formed over here, which could potentially bring us to about 13.30, which is about over 3% upside from current levels. Yeah, so I think OCBC is stock to watch out for. Yeah, and just to add on, usually we have a mid-cap pick, but for this quarter, we don't really have a very strong mid-cap that's currently in a strong uptrend for now. So yeah, just for a heads up. Yeah. So now we move on to the banking sector trends. I'll pass on the time to Glenn. Thanks.
Hey, thanks, Zee. So I'm Glenn, I'm the banking analyst. So to start off with this chart is the rates chart. So we've actually plotted the Singapore rates, which is the light blue line you can see there, as well as the Fed fund rates. So you can see that, as Paul mentioned earlier, it's been going up, but of course we do expect sort of a dip in the future. I didn't plot that out, but the red line there, that's the interesting one. That is the NIM, average NIM of the three banks in Singapore. So it is extending a bit further than the interest rate lines. That's actually our forecast. So you can see for 2023, we still do expect it to continue to increase, and the banks have also guided as much. And in the last quarter, I'll speak a bit more about that later, but the last quarter, they did release their NIMs, and it was above our expectation, and they also guided for a higher NIMs going into the 2023. But in 2024, you can see that we have actually forecasted a negative 2 basis points, and that is to sort of explain the drop in the interest rates. So moving on to the next slide. Yeah, so this is just a brief sort of highlight of what happened in the last results in the second quarter. You can see, as I mentioned earlier, for all three banks, they have sort of reported very high increases in their net interest margins, and this is mainly from the continued high interest rates. And this, of course, has benefited their net interest income. You can see that it's around 30 to 40% growth for the net interest income, and this is mainly from the net interest margins. So I think this is double-edged sword for the interest rates. The first thing is that it's a good positive for the banks because it benefits their net interest margins and the interest incomes. But what I didn't put here would be their loans growth. Loans growth actually has been quite flat for the last few quarters. And so, this is affecting them slightly. But on the hindsight, if you look at their PATMI, the net interest income and net interest margins growth has more than offset the loans growth decline or stagnation. And I think the main point of the title of my slide here is that the dividends have jumped by 39%. And if you look at the last line here, you can see that dividends have increased substantially for all the three banks, and we do expect that this will continue going on into the next few quarters. So moving on to the next slide. Yep, so we would just like to highlight the CASA ratio. So it might not be a very known thing to many people, but CASA stands for current account savings accounts ratio. So these are the deposits that the banks have in your current account. So for all three banks, they have it. In DBS, it's like the multiplier, OCBC is the 365, and I think the UOB is the one account. So these are accounts that the banks give very low interest rates, right? So I think the base interest rate is like 0.5%. So these are essentially like very cheap deposits for the banks. And so the higher the amount, of course, it'll be better for the banks because it means their funding cost is lower. So this is sort of a direct relation to their funding cost. And you can see, over a year ago, the CASA was extremely high. Sorry. Yeah, CASA was extremely high. And this was mainly due to the people were putting into their savings accounts. But it started to dip slowly over the COVID period because interest rates were coming up. And after COVID, so people were putting it back into fixed deposits, hence the decline. And we can see that the CASA proportion, which is the percentage of their CASA to their total deposits, has been slowly declining. And this might not be a very good thing for the banks because it means that their funding cost is creeping up. But they have managed to control it over the last 6 months. You can see in the red line there, it has been sort of flat or stagnant at around 18.9, 18.8%. So they have also mentioned that in their previous results, all three banks, that their funding costs are being controlled. So that's how they're managing to push up their NIMs, their net interest margins. And they're looking to see that this will continue in the next few quarters. Yeah, so that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Good morning, everyone. I'm Darren. Yeah, so this is just a slide on the third quarter performance for all the S REITs. So one thing to note is that this is a total return, so it includes dividend payments as well. So if we do not include the dividend payments, the S-REIT index, as you can see over there, the year to date is about down 10%, while if we include the returns, is down about 4%. So as you can see here, the industrial year to date, the performance is quite good at 5.2%, mainly because we think we came in at a lot of the reversions were positive, double-digit reversions, while more of the diversified as well as the commercial space year to date is down. The commercial space down mainly because of the US REITs, which was down quite a lot, as you all know. So as you can see, just for the third quarter results, the third quarter performance, a lot of the industrials also, the performance was quite flat, while the same thing as commercial and diversified, also the laggers per se. But one thing to note is as well is especially the fact that after the Fed came in with the higher for longer stance as of the FOMC meeting in September, middle of September. After that, within the past 3 weeks, the share price of REITs, it came down by about 6%. So a lot of the losses were from that after the meeting. Yeah, next slide, please. Yeah, then this graph is actually the S-REIT yield spread versus the 10-year Singapore government savings bond. So how you can see this chart is actually the Singapore dividend yield minus the interest rate of the 10-year Singapore government savings bond. So we use this 10-year Singapore government savings bond as a yield proxy, or rather as a kind of a risk-free interest rate. As how we interpret it is how much dividend yield are you getting when you invest in the S-REIT market versus a so-called risk-free rate or a risk-free asset or a yield proxy per se. So for now, you see that the yield spread is now only about 200 basis points as compared to the historic 10-year mean at 300 basis points. So this means that you are not compensated as much when you invest in S-REITs as compared to the 10-year historical. But then there are some other reasons why we are overweight REITs because of mainly the next slide. Yeah, so we see here that the price to NAV of the REIT index now is at 0.886 times, which is almost at -2 standard deviations of the 10-year mean. So the 10-year mean is usually REITs will trade at about slightly above 1 times of the price to NAV. But right now we see it's trading at 0.86. So we think that over time, the REITs will trade back to its price to NAV of about 1 time, and it's kind of a good yield play here. And because of the recent correction in the share price within the past 3 weeks, we think that the market has partially priced in the interest rate hikes and the higher for longer stance as well. So we think if you are a long-term investor, it might be a good time to start repositioning into REITs to kind of position. Sorry, we take questions after that. Yeah, so we'll reposition. Do you think if you are long-term investors, a good time to reposition into REITs to take advantage of the fact that the rates will start pausing and maybe kind of go down again, go down in 2024? Yeah, next slide, please. Yeah, so this is the price to NAV versus the dividend yield chart. So it's basically it's more of the individual stocks rather than just as the REIT index. So as you can see, a lot of the Singapore listed, the big cap REITs are trading around under 1 times. Usually they trade about slightly around 1 to 1.05 times price to NAV and around 5 to 6% dividend yield. But you see now, because of the recent share price correction, a lot of them are trading at under 1 times price to book, and they are trading about 6% dividend yield. So we think that is a good entry point there. And on the cheap side, as you can see, Prime and Kepple Pacifico, actually Manulife is also there, but then because they halted at dividend payments, that's why I took it out from this chart. But the reason why we think that they're trading low is, we all know that because the US market, the office outlook is very weak, but there's some silver lining as we think that there are a lot of companies kind of forcing their employees to return to office already. As you can see, Goldman Sachs, recently they said that they want their employees to go back to office 5 times a week. And we also see companies like Google, they are putting in their return to office, like they're factoring in the return to office of the employees into their performance appraisal. So if you go back to office more, then maybe your performance appraisal will be better. Yeah, so because of that, we see a lot of possibly a lot of the employees will start going back to office, and we think that there will be a good sector recovery in the US office space maybe in the second half of next year. So now it's still quite weak because of the slower leasing and the weaker macro environment where a lot of companies are still downsizing. Yeah, next slide, please. Yeah, and then this slide is just to show that even though we are overweight REITs, we do not think that there will be a lot of DPU appreciation potential, or rather the dividend yield for the REITs will increase a lot because mainly of the higher finance costs. So this is just a sample of some of the REITs. As you can see, for CapitaLand CapitaLand Ascott Trust, for example, the MPI for the first half, it grew 31%, but then because of the higher finance costs, which increased 33.1%, the DPU only increased 19%. I mean, that is really the best performer. Like in this current environment, we think hospitality is the only sector that can produce or rather improve their DPU year on year because of the higher RevPAR, which I'll show you later in the slide. Because of the increase in that, will directly contribute to the top line, and this increase in RevPAR can also offset some of the higher interest expense costs. While some of the other REITs, as you can see here, even though their DPU, their MPI increase and their finance costs increase, I mean both the MPI increase and finance cost increase, but their DPU remains kind of flat. Yeah, but I'll just use a Kepple REIT, for example. Their MPI is kind of flat at -0.2, but then because of higher finance costs, the DPU is down 2.4%. But this, even though it's down 2.4%, actually it's down even more if they did not include the 10-year anniversary distribution of 10 million. So if you exclude that 10-year anniversary distribution, the DPU will be down about 10%. And for Prime US REIT, the MPI is down 7.2%, but then you take into account finance costs, the DPU is down 30.1%. But this also includes the fact that they paid their management fee fully in cash. Yeah, so if you exclude that, the DPU change will be about -24%. Yep, next slide. And yeah, so we still favor the hospitality subsector because mainly the RevPARs are at all-time high levels. As you can see, a year-on-year increase of 26%, and it's at all-time highs. And currently, we see the visitor arrivals, Paul mentioned a bit about it earlier, is 79% up year-on-year. And the Chinese tourists right now account the Chinese tourists are still about 60% of pre-COVID only. So there's still a lot of potential for the Chinese tourists to come back and help to boost up the visitor arrivals. And as a result, the RevPAR will probably start to increase as well. Yeah, next slide. Yeah, so this is just a slide on property. So for property, yeah, we note that there are more launches in the this year and lower take-up rates. As you can see in the chart over here, these are the recent launches. And as you can see, the launches, the take-up rate on the first week is not as high as last year. Last year, the take-up rate, a lot of the launches sold out over the weekend, but now we see about some 20%, some 30% only. Yeah, and you see the TMW Max that residential property in the core CBD area, that one is only 2% taken up. Because we believe the demand coming from property now, most of it is first-time home buyers and Singapore residents. So, and with the increase in BTO supply as well, like this year there is 23,000, last year also 23,000. So, but in 2021, it was only 17,000. So because of all this increase in supply and a lot of the demand coming from first-time home buyers because of the ABSD for foreigners at 60%. So all the foreigner buyers are most of probably they are not here anymore or much lesser. Yeah, so because of these reasons, we think that demand will kind of slow down for all these private assets because with first-time home buyers, a lot of them will probably go to HDBs rather than they pick up all these private properties. Yeah, and the key thing is the launch pipeline. Like this year, there's it grew 155% year-on-year as compared to last year. So there's more supply as well. So that's why we are neutral on the property sector. Yeah, that's all for me. I'll hand over to Peggy. Thanks.
Thank you, Darren. Morning, everyone. I'm Peggy. I'll cover 4 sectors over here. The first sector is conglomerates. So mainly just 2 companies, Keppel, Sembcorp, as well as ST Engineering. But I shown this chart here because the Keppel and Sembcorp, if you are not aware, they are most of the For Kepple, 68% of the earnings comes from energy sale. For Sembcorp is almost 70-80% comes from energy sale. So energy sale in Singapore is the core, very important for them. Okay, this chart shows. Let me explain the chart. This blue shaded one is the capacity, Singapore's energy capacity, generation capacity. And over the years, actually, our capacity has been reducing in the entire Singapore. Well, the line over there shows the reserve margin. How do we read reserve margin? Reserve margin is the peak capacity at any point in time, right? Over the peak usage, peak demand over the capacity. So maybe in the middle of today when we all turn on the aircons, right, that is the peak capacity. So the lower the margin, the more dangerous we are. As means we are going to we are using a lot of energy out of our capacity. And the comfortable level for the EMA, Energy Market Authority, is about 35% for reserve margin, but we have dropped to even into below, about 20%. And then in July this year, when we saw the energy prices spike, May and June this year, the margin was actually below 25%. So why I show this chart is the fact that the demand for energy has continued to rise while the capacity is falling. And so therefore you hear about Sembcorp, Kepple having their customers come to them and say, hey, I want long-term contracts. But these long-term contracts for the customers they sign is for volume. That means the take-up volume, but it does not tie them down to the power price. So when energy price is up, Sembcorp and Kepple actually able to manage and have a good handle on the margin. The introduction of the temporary price mechanism by the EMA is only to smooth out the peak demand, the price during the peak demand, but it still gives them a very good margin for all these power producers. So therefore, the two, Kepple and Sembcorp, we had one is accumulation, one is a buy, purely because the core earnings is intact. In Kepple, we have catalyst from the asset sale. Okay. So this is for conglomerates why we are overweight. The next one, please. Okay. For the building material sector, okay, this is very closely tied to construction. Maybe you ask me why not talk about construction? And because it's really we are concerned. For constructions, we hear about failures lately, like Yongnam is the most recent one. The UOB has begin to ask for repayment of their loans. Okay, so there's some weakness in the construction sectors among some of the players. The building materials will do well. It sounds a bit contradicting. Let me explain. So this is the chart that shows the contract awards by the industry-wide contract awards and the progress payments. Progress payments actually represents the work done, and then these contractors can now view invoice their customers. So progress payments usually like 12 months lag from contracts award. So last year when the contracts award came down, generally we were worried that hey, this year maybe the volume, the progress payments might slow down because it's a 12-month lag. But still, we see that the progress payment has been rising quite nicely. So therefore, the contractors have been there's more work being done, being performed, and going forward, the blue line up to now, year to August, is still trend below the BCA, Building Construction Authority's target of 27 billion for the whole of this year. It's still now right about just below 26 billion. So we think the blue line will continue to hit higher for the rest of the year, and that will underpin the red line to go up for 2024 and 2025. And for that, we like the building materials because these are the guys who are supplying the materials. And for like Penn United and BRCs, the price, they have a fluctuation clause that is monitored by the BCA that allows them to pass on all any price increases or decreases through the systems. Therefore, they don't have to worry about any inventory loss. The only concern probably is the weakness in among the contractors that might that might affect the building materials suppliers. So what the material suppliers are doing right now is to either buy credit insurance for those contracts, so that once they supply the materials, they get credit insurance, so that they are guaranteed about 90% of the payment. The other way is, of course, they only supply to the reputable contractors. So therefore, we still have an overweight for the building materials providers. Next. Okay, air travel. Okay, the last time when we were here, I had a reduce for SIA, and I'm still maintaining that. It's a reduce, although I'm keeping my target price at 680. This chart will explain why I'm keeping that stance. Okay, the total market is according to IATA, the total passenger kilometer volume. Right? We calculate by number of passengers times the number of distance that they travel. The industry has risen by 26.2% in the month of July, but that is 4.4% below a pre-COVID level. Okay. And the strongest market, of course, was Asia Pacific, because we are the last one to be open. But I think at this level, we have almost reached the peak air travel demand. Why so? First thing is the corporate travel has not recovered. Okay. Most of these surge in demand over the last few months has come from leisure travel, and leisure travels which means the budget carriers are getting very, very good load factors, but not as good for the main carriers. The second thing is that the geopolitical tensions means that some flights will not be resumed so quickly. Like for instance, from China to US, the number of flights has actually reduced. So the volume of travel on those routes will be reduced. And then the third thing is the third thing is that there's possibly a potential slowdown in the US. So and you look at the last part over there, US has been the one that has been it's actually gone above pre-COVID level. So there's a risk of it coming down. And US accounts for a very big pie of this total volume. So for this reason, we think that we are not bullish on the air travel market. And the recent problems with that does not help this sector is the higher jet fuel prices, as well as the engine problems with Pratt & Whitney and CFM. So the airlines will find it difficult to put back the capacity that they want to, even if they don't want to. Thank you. You see? Yeah. So I talked about shipyard here. Though we don't have a coverage for Seatrim and Yangzijiang, but we meet them regularly. It just a highlight of their order books currently. It has actually spiked up recent over the last 2 years. And in Yangzijiang and Seatrim, the order books is almost, in fact, Yangzijiang is higher than Seatrim right now. Most of these order books, why we are neutral on the sector, even with this, right, is that we think they are not adding capacity. So therefore, the revenue is almost peaked. And the order book is stretched out over to 2026, 2027. Okay. Most of these orders are coming from the green vessels, the green, like the methanol, those run on methanol, or dual fuel vessels, or they are the refurbished ones to add scrubbers to ensure that they meet the IMO standards. So the orders comes mainly from those liners who needs to meet the IMO standards. And IMO has bring earlier the targets for carbon emission standards. So there's the rush to order. But in terms of value, it looks high, but in terms of volume, it's not that great, because most of these vessels are very expensive. So there's a very high capital investment cost, and so these ship liners are thinking very hard whether to spend that money to invest in these new vessels. And in worldwide, there are not many yachts who can handle this the construction of these vessels. Therefore, Yangzijiang has an advantage for methanol, and the Koreans are good in LNG and so on. So the drive towards meeting the emission standards is the driver for this shipyards sector. Yeah, but the Seatream and Yangzijiang have diverse fortunes, I would say. But Seatream is probably going to be still loss making this year, and the Singapore foreign quota is going to change again for January 2024, which is not helpful. Whereas for Yangzijiang, on the other hand, the construction, the labor cost for them used to be above 25%. Now it's below 20% because the Chinese the labor cost has reduced. It's much easier to get the workers. So and they focus on the methanol fuel, which methanol vessels which are higher in value. So we have a neutral rating for the sector. I pass on to Paul for the rest. Thank you very much.
Okay, thanks. I'll cover electronics sector now. So for Singapore electronics, there's only two parts. We don't have like many electronic companies. It's mainly semiconductor equipment makers or suppliers to semiconductor equipment. So your UMS, your AEM, your Franken. So these are mainly equipment. So I just want to make sure everyone understands. And then we have this one guy who just got kicked out from MSCI, Asia Business Venture. For us, for semiconductors, our view is still neutral. What is happening now in the semiconductor is there is a bit of a pickup, but it's still very sluggish. So who's buying semiconductor equipment now? It's mainly the Chinese, because they want to hoard, because they do not know when the US shut down and say you can't buy any more, even more semiconductor equipment any more semiconductor equipment. And the other party that's buying is, of course, AI, those who are building AI, but the volume is thin. And the third one is the new wafer fabs, onshoring, friendshoring, whatever shoring I call it, which is being built in the US. So, but in conclusion, we think demand is still sluggish. Although we saw there's a bit of a run up for some of these share prices, but when you look at like Applied Materials results, the guidance, although it was raised, but year on year it's still flat. So it's still a sluggish environment. The reason I put this chart, I ran out, not that I ran out of ideas to put, but this is a US retail sales of electronic appliances, the red line here. So like I mentioned earlier, when we talk about demand is either you replenish inventory or there's end consumption, there's people really buying. So we think there might be a slight pickup because the inventory is low, so there's a bit, but the end demand is still really big. So if you look at US consumers buying electronic products, I think the red line can show you that it was a fantastic time during the pandemic because everyone started home, everybody bought laptops and so forth. Right now, the growth is hardly anything. It's still down negative. So that's why we are still quite cautious on electronics because the end consumption, the end demand is still exceptionally weak. Next slide. So the next one is telcos. We were quite neutral, but we turned overweight. We'll talk about StarHub now, then we'll talk about Singtel later. I know there's only two. So for StarHub, this is StarHub's earnings. So you notice that these were the fun times. I know the time you don't have WhatsApp, nothing much to do. Just make sure the power don't go down. No, you just collect your SMS. So this was fun. You just pay good dividends. Best to be the CEO here. Then when 4G came, then that's where you really have to work hard. Then after that, the mobile operator. Then after that, PPG came in, competition came in. Then the earnings dropped to FY22, 400 million. But we think there's going to be a pickup now, mainly because StarHub is spending 300 million. So that's a lot. Man, just spending 300 million to do, they call it their plus transformation, but it's more like trying to fix up the IT system. And also by EPL, by the way, by EPL. So we think there's a pickup mainly because most of the restructuring is over. I think that 417 probably, most of the restructuring cost is going to be completed by this year mostly. Number one. Then number two, for StarHub, hidden inside StarHub, there's a very, very strong cybersecurity business, which most of us don't really put valuations into it because it's loss-making. Most of us value telcos on EBITDA, but that one, the EBITDA is very thin. So there's a jewel inside that is yet to be monetized or what. So that is one thing. It's called Ensign. Why is it a jewel? Because they do cybersecurity for the most difficult customer, which is the authority. So this is a very strong business, which if they you can either monetize it by listing, trade sale or something, then they could actually take the share price up. The third thing is, of course, consolidation too. 4 is too many, we just have too many operators. So most likely there could be a consolidation. The timing is unclear, but I think the authorities should also be a bit more friendlier because they see that prices have really come down. Just look at the profitability. And there's also a change of parties involved, those heading those departments. So we think that there is possible upside for StarHub, but I think the third quarter results will still be weak because they still have a lot of costs to come up. But they also announced a 50 million share buyback, so that kind of helped the share price too. So we think earnings have bottomed, and also with roaming coming up, which is like 90% profitability business. No, roaming is not all of us. I think all of us are paying it now as we go travel overseas. Next slide. Next one is healthcare. Just an update. We are neutral. So for healthcare, like you look at Raffles. I mean, there's not many stocks. There's probably Raffles and Thomson. Raffles did well because sometimes you cannot say well. When you say well, means they got a lot of patients, means a lot more sick people. So let's say that the volumes improve. So Raffles volumes improved because firstly the pandemic, then the government had, so phase 1 was a lot of pandemic. So when you do testing, you do vaccination, very good business because desperate, there's no, so that was the first wave. Then the second wave came for them was foreign visitors. So when you reopen, then all the rich Indonesians came, and then that was the second wave of earnings growth for them. Then the third wave for them was the public hospitals were very tight, capacity was very tight. And this will continue because one of the issues is that a lot of patients stay in the hospital in the beds because there isn't family support. But I mean, let's not go there. It's not a social enterprise talk here. But so as a result of that, the public hospitals has a crunch. That means the waiting times were long, not enough beds. So the government came out with this thing called transitional care facility. It's like hospital mini-me. So it's like a smaller version. There's no operating theater. But at least you can park the patients there for 1 week or so. So don't take up the important. So that was the third wave. But we think all this is winding down. So that's why we are neutral on the hospitals. And of course, in the background, we got this healthier SG. Healthier SG means it's healthy for the government, healthy for us, not healthy for the shareholders of those being healthcare companies. So the reason why we say that is that the government wants to bring down the cost because Singapore is aging fast. So they're trying to bend the cost curve. Then cost curve means somebody is bend someone's revenue too. So obviously the GPs especially. So what they're going to do is they're going to give, okay, this area, the number of clinics, all the GPs have to bid for the patients. So bid means margins come down, and then you have to take a risk that these patients that is under your pool don't get too sick, because if too sick means it's your problem. So basically, they're bending this cost curve, means bending everyone's revenue. So it's good for us. I mean, I'm happy with Healthier SG, but it may not be so good for the healthcare company. So that's something that we are watching and a bit more cautious on. Next slide. Okay, so stock pick. So that's me when I play that. So this is a stock pick. So as accurate. So it's our model portfolio. The additions we did, we took out SGX and CDL. SGX we took out, even though the thesis was right, the earnings was healthy because of the improvement in interest, but the share price just didn't react, so we took it out. CDL was really hurt very badly when the cooling measures came in. We added in ST Engineering, which Peggy will share, and we put in Singtel. So for last year, the best performer finally after so many years since the dinosaur time was our Comfort. And we'll talk about it later. So this is basically our model portfolio of 10 stocks. We don't put 20 because it's too many. But of course, ideally in any portfolio, you should at least 20 stocks for diversification. But the performance and performance just for illustration. Next slide. So this is just a performance. We were probably down year to date about 5%, but as the market is down about 1%. This excludes dividend, so we are quite heavy on this. Next slide. Okay, so let me talk about some of the stocks. So first one is ThaiBev. So this is the Thailand consumption indicator. So there are two reasons why we still like ThaiBev. The share price has been weak recently because I think in Thailand they just raised rates, and also the GDP has been weaker than expected. And the currency also came off quite sharply, at least this against the Sing dollar. So these are some of the reasons, but the valuations are low. I don't have the chart here, but ThaiBev valuations now is actually lower than even the pandemic lows. And there's a lot of fiscal catalysts. So for those who may not know, Thailand is coming out with this thing called digital wallet spending. So they're going to give every Thai adult citizen almost 400 Sing dollars. Just give you cash, and then you must spend it within 6 months and within 4 kilometers. Okay, the 4 kilometers, I'm not sure how they're going to resolve it. What if you spend 4.1, then you cannot spend? Who's going to reject you? So I'm not sure. So they're going to have a lot of issues rolling that out. But this will boost the economy by almost 21 billion Sing dollar of spending. So this will happen next year. Of course, if I get the money, of course, I'll also queue up for alcohol, but you cannot use the money for alcohol. But you can actually exchange it for cash, and this will also still flow through. This benefit ThaiBev, because ThaiBev is very strong in rural areas. So most of the business for ThaiBev, ThaiBev is mainly selling rum. 90%, 80% of the profit is rum. Although you got Chang beer, but Chang beer is only like 5-10%. So most of it is rural. So you get this big catalyst, and then because of the new government coming in Thailand, they're also trying to stimulate with minimum wage. There's also farmers' debt moratorium. Just tell farmers, I don't have to pay your debt for, I don't know, 1 year or 2 years. So that's fun. So this we think is all the fiscal catalyst, but you won't see it this year. I think this is all going to happen next year. So that's why we have ThaiBev. Next slide. Next one, okay, everybody knows. Okay, so anyway, for ComfortDelgro, there's maybe 3 reasons why you see them coming up the market more, because things are looking good. So you'll see the management also a bit more proactive in marketing. But the title, this is the amount of trips. So this is the blue line is street here. There's your taxi, you wave. Nobody does it anymore. So that's why you can see it's coming down. But the growth area is a P2P. So there are three growth drivers for them. Firstly, when you see here, when the title suggests rebound in pricing, so they were hurt very badly in the UK, because in the UK there was bus strikes, so they had to pay all the drivers much higher wages, and you only get compensated like a year later. So it's happening now, especially in the second half. So that's the first one. Then in China, they had to pay taxi rebate, they had rebates and so forth. So that's the second reason. Likewise was for Singapore. They're also repricing all your ZIG, because as you all know, may or may not know, Comfort now uses ZIG, and ZIG is performing quite well. And ZIG, they raised the price, they introduced platform fees, they raised the commissions. So one of the reasons why ZIG is performing well, which is competing against Gojek and Grab. Of course, firstly, Grab now has suddenly decided to become profitable, so they cannot give out so much subsidy. But the more important one is the commissions that ZIG gives is only 8% versus the peers 20%. You also get cheaper fuel if you're a driver. And this is a bit of a quote. If you use ZIG, they only usually look for drivers within the 1 kilometer, which is good for drivers, not so good for us, but the drivers like it. So that's why ZIG is performing well. And you get the kicker in the second half because they just charge platform fees. And as you can see, most of passengers, taxis are all using the app rather than street hail. And the fourth reason is the volume. Why I say volume is that when rail volumes go up, they benefit, especially the train, mainly for the train rail business. So just to recap, now Comfort has taxi in Singapore, rail in Singapore, of course, and then bus. And then they have a UK bus and also Australia bus. So that's why we think second half you should see quite a strong rebound. And they also raised their dividend commitment, I think, to 70% now. Okay, hopefully I get that number right. Yeah. Next slide. So I think the final one for me, we still like PropNex. The share price was weak because the results was below expectations, and mainly because of this chart. So this is the number of transactions. So PropNex is the largest real estate agent with almost 40 to 50% market share. So one of the reasons we like it is also, again, very rare to get any company in Singapore with a 40% to 50% market share. So every 2 homes, one is actually done by PropNex. So the volumes came down even before the cooling measures. Volumes were already coming down. So that's why their first half results was poor, you can see. But we do see a rebound in July and August, which is the third quarter. Don't have September number yet, but volumes were bounced back by 40% year on year. So that's why we think second half will be a recovery. And anyway, by default, last year there was 4,000 launches, like Darren mentioned, but this year there's 11,000 launches. So that's why the volumes we think can rebound, and they're paying like a 7% dividend yield, which is backed by 140 million net cash. And like we mentioned before, the dividend is based on 40 million operating cash flow, which they generated every year anyway without even having to touch their net cash. Next slide. Okay, so the final one is we added Singtel. Not because we think telcos is doing so, everyone is rushing to buy a new handphone or so forth. Mainly two reasons. So this is the regional. So then let me recap Singtel. So Singtel has Singapore, they have Australia, and they have all these countries. India is Bati, Thailand, EIS, Telkomsel, Indonesia, Globe is Philippines. So after being hit for so long, we're starting to see mobile prices recover. So this is the mobile price index of the regional companies. So you can see India is doing very well because competition is a bit more stable. But the main reason why is because the economy is doing well. So always remember that for emerging countries like India, Indonesia, telco mobile spending is a bit more discretionary. So it's prepaid. So when you have money, you top up. So it's not like us every day forced to pay the monthly. But this one is when you have money, you spend. So we think the next chart to go up is of course Indonesia is up, is Thailand especially, because they are from 3 mobile operators, it went down to 2. But you notice prices hasn't moved up yet because the economy there is weak. So the economy there is weak, they tend not to move. So, and also likewise for Globe, supposed to be 3, but the third operator is neither here, neither there. It's supposed to be from China. But so we think even the red line and green line, you will see mobile prices also picking up. So that's why we like it. And the second one here, divestments, is because they committed to 6 billion of divestments. They already done almost 2 billion because they sold out Trustwave, a loss-making company recently, and they sold a stake in their data centers. So it's not only just operationally, but divestments. Yeah. I think I'll move on because of time. Okay, I'll hand it over to Glenn.
Thanks, Paul. Yeah, so for our banking sector, the topic will be OCBC. So OCBC made 3 main points. I mean, the first one would be the attractive valuations, and of course, OCBC still remains the cheapest amongst the 3 local banks. The second one, which is the title of my slide here, is that the dividend yield has reached a record high, and it's also the highest amongst the 3 local banks at it's hovering around 6.5% right now. Yeah, so I think I would like to explain further on how they get this dividend yield to be so high. Of course, firstly, I think to touch upon the CET1. So CET1 is this blue bar here. CET1 stands for Common Equity Tier 1. And if you put it in very simple terms, this is the sort of the highest quality equity that the bank has. It's their basic building blocks for them. So what they can do with this CET1 is either to have acquisitions or to spend it on dividends. And if you look at their peers like DBS and UOB, they have done so with the Citibank acquisitions. So they have spent their CET1 for those acquisitions. But with OCBC, they haven't really done any sort of major acquisitions. And all 3 banks have actually boosted their dividends, and this is mainly from their earnings growth. But with OCBC, we see that there is a potential for them to continue to increase dividends further or even more than their peers, right? So which is why we are expecting both their CET1 to continue to increase as well as the dividends for the forecast in 2023 and 2024. And the third point I'd like to bring up is that we could see potential further improvement in their fee income and their wealth management side. So they've mentioned time and time again, I think the last 2 quarters, they did say that they do expect an incremental 3 billion revenue increase over the next, until 2025, and it's mainly coming from China. So, but they do not really give much detail, so we can only sort of guess and assume that this will be in their wealth management side. So that is one of the sort of growth for them moving forward for OCBC. So as such, we do maintain a buy rating and the same target price of $14.96 for OCBC. Thanks. I'll hand it over to Darren.
Yeah, thanks, Glenn. So for Capital Ascott Trust, as you all know, it's a hospitality REIT. It has a geographical presence. So as you see the RevPAR growth year on year, right now it's at 149, and I mean it's because of seasonality, that's why it's lower than the December or the 4th quarter 22, but we expect it to trend up in the next quarter, especially 4th quarter, where the return to travel is more prominent. And just for those of you who do not know, RevPAR, it means average daily rate times the occupancy. So right now, in a lot of countries, the average daily rate is already at all-time highs. So, and of course, all-time high means better, higher than pre-COVID as well. So we believe that the growth going forward will be from higher occupancy. So right now it's about 80%. So we believe can go higher. Yeah, and recently, CapitaLand Ascott Trust, they have a DPU of 6.8%, and that's mainly because the share price corrected quite a bit after their rights issue. So as you all know, their rights issue was priced at $1.25. Right now, the share price is about 90 cents. So as of come date, or rather the come rights date, the share price was already trading below the rights issue of about $1.25. So as a result, a lot of the shareholders did not subscribe for the rights. And as a result, it was only about 36.6% taken up, the rights issue, but it was fully underwritten by the runners and the banks. So they managed to raise about 100 million from the rights issue, and that's about 100 million shares. And if you combine it with the private placement they did before, about 200 million shares, it's about 300 million shares, and it accounts for about 7.5% of their total share volume. So when we look at the average daily volume of Ascott, it's about 7 million. So let's say if, because of let's say if those who took up the rights, they want to sell their shares, they don't have enough volume and to sell the shares every day. So as a result, we think that's why some of the reasons why the CapitaLand Ascott Trust, the share price is quite weak, and we think it will be weak for the near term. But in the longer term, we believe the hospitality recovery can help to drive their growth, and which is why we still have an accumulated rating with a target price of 120. And we believe the return of Chinese travelers as well globally will help to boost up their performance. Next slide. Yeah, so for Phillip Centrepoint Trust is Singapore's only pure play suburban retail mall. So their strategy and why we like them is because they focus on essential services. As you can see here, they are very heavy on food and beverages. And their top 10 tenants are like NTUC FairPrice, Breadtalk Group, Dairy Farm, which is your 7-Eleven, Guardian, and your Cold Storage, and Taobao is your, that is McDonald's. So you can see their top 10 tenants are very resilient, and it's not those high-end restaurants, and in like a weaker economy and a weaker macroeconomic environment, all these are really where all the people will still go and kind of do their shopping and eat. So because of that, we believe it's very resilient, their strategy, when they focus on these essential services. And one other point is also that they recently divested Changi City Point at about 4% above valuation. So this is a good sign for us because it shows that the Singapore valuations, property valuations are remaining quite high, are rather stable. And it's very different from overseas where you see a lot of asset valuation declines. Another reason is because we like FCT because their occupancy cost, which is your rents that you pay divided by your tenant sales. Right now, the occupancy cost is about 15%, and historical is about 18%, and it hit about 20% during COVID. So because occupancy cost is low, we think that a lot of potential for them to reprice their rents going forward and have a better positive rental reversions going forward. And right now, FCT has a forward dividend yield of about 5.7%, and we think is stable and resilient. Yeah, next slide. Yeah, so for CapitaLand Investments, we like them because of their FRB, which is their fee-related business, where they collect fees from managing their listed REIT platforms as well as some their lodging management, as compared to their real estate investment business where they earn the revenue from their balance sheet and the ownership stake in some of the REITs and the investment platforms. So as you can see, we forecast that their fee-related business will grow 9.9% over the next few years, compound annual growth rate. And we see a slight dip in the real estate investment business performance in the we forecast a slight dip because of a weaker performance in China, as well as the absence of event-driven and property event-driven fee, rather divestments. Because now of the high interest rates, it's quite challenging for them to do asset recycling, as there are not many buyers out there for all these properties. So as a result, you see lower divestment fees and lower divestment gains and portfolio gains from these divestments. as well as it also affects the fees that they get from when there are no divestments, they also get lower fee income from these event-driven fees. Yeah, but we like them because of their recurring fee management, especially from their lodging segment. Their lodging business really performed very well. Year on year, it's up about 36% for the first half. And their lodging business also benefits their REIB, their real estate investment business, which helps to offset the poor performance in their China properties. Yeah, so yeah, we have a buy call with a target price of 368. Yeah, so that's all for me. I hand over to Peggy. Thanks.
Thank you. Okay, we initiated coverage on ST Engineering. Why ST Engineering and why at this time? Because we think the possible slowdown in the global economy will bring attention to balance sheet. Increasingly, investors will be asking about balance sheet. Is it okay? Are they generating cash flow? So ST Engineering is one that fits the criteria very well. Firstly, the ST Engineering has a very strong cash flow. Some of the defense contracts that they have, they collect down payment upfront, and so therefore the cash flow, they always generate free cash flows. So far, even positive free cash flows. But just bring back the attention to this chart is that the order book for ST Engineering, I plot it against the Singapore defense and security spending in the country. They actually quite in line. They rise in tandem, and with the geopolitical tension and cybersecurity threats, Singapore has actually been spending more into this space. For last 2021 and 2022, the spending was up like 12%. 23, the budget is 6%, but they might be more than that. And ST Engineering has been able to raise the order book to now record level of 27.7 billion. Of course, not all the 27.7 is from security and defense, but still they're riding on the upward trend in Singapore spending in this sector. The other reason for buy on ST Engineering because they're very big in the aerospace MRO. Right now they are like almost double the size of SIA Engineering. Okay, and they have bases all around the world. And this MRO stands for maintenance, repair, and overhaul for aircraft. There is benefiting from the reopening. There's more demothballing of idle planes, and as airlines start to fly, add capacity to the system. So there's more MRO activities. And more recently, in the last 2 weeks, you hear about the engine flaw in Pratt & Whitney and fake engines from CFM. All this means that there are more, the airlines might have to ground the planes for more checks. So that will means more man hours required, benefiting the aerospace MRO sector. So for these two reasons, we are recommending a buy on ST Engineering. Okay, thanks. And for Kepple Corp, we're still maintaining a buy for this conglomerate. As I mentioned earlier, this is a power story. Power generation of power requirement of Singapore will underpin the earnings for Kepple Corp. But the upside potential, the catalyst to share price is really from their focus on asset monetization. They have about, together with the joint ventures that they have about 66 billion worth of assets that could be monetized. On their own balance sheet, there's about 12 billion. So what do they mean by monetization? Means they will put it onto fund platform. And some of these funds under management are managed by themselves. So they plug it into the fund platform and then raise third-party monies. They convert from asset management to become to generate recurring income from fund management. So with a greater percentage of the earnings coming from recurring income, the market would then probably going forward tend to use a PE valuation to value them, because recurring means you can see it coming earning net. So then the focus will then be on SOTP, the sum of the parts, well, to become a PE valuation. So they are trying to copy like a CapitaLand Investment, a mini-me, but was really going in the right direction with a target fund management of 100 billion for FY26. Thank you. That's all for me.
Thank you, Peggy. Hi, I'm Mel, the rate analyst. So we initiated Suntech last month. Yeah, we initiated Suntech last month with a buy recommendation and target price of $1.47. Suntech is a diversified commercial REIT with 67% of the income generated in Singapore, 20 from Australia, and 13 from UK. So we like Suntech mainly because of its cheap valuation. As shown on the graph, now it's trading at 0.54 times price to NAV. That is very much lower than the average of S-REIT of 0.86 times price to NAV. And now the forward dividend yield is 6%. There are some concerns over Suntech's high gearing of 42.6% and the low portion of fixed rate debt of 58% versus the peers capital rate of 76% and CICT of 78%. However, we believe Suntech will be the one benefited the most from the interest rate cut. And in first half 2023, it has already successfully divested 3 strata units with price 20% above book value. And the management is also confident that they can bring the gain down to 40%. Yeah, that's all for Suntech. I'll hand it over to Paul.
Okay, it's not like I have nothing else to do than initiate stocks and cause more work for myself. But okay, so I did initiate one stock called Valuetronics. It's a contract manufacturer. So contract manufacturer is like what Venture does. So they will help assemble products and ship up. They do some for Philips, and there are a lot of other customers which cannot be named, but it's mainly a lot of industrial. They have also for auto customers. So anyway, the story for this is firstly, I met this company for more than 10 years, but what has happened is that since 2018, you'll notice the revenue has dropped for 5 years up to FY23. Mainly because they were the number one victim. If you want to do a case study of who got hit by Donald Trump's trade tariffs, trade war, then this is the guy, because all his factories was in China. So for the 5 years, he had to transition. So he had to build one new factory and then secure new customers. But the main reason why we like it is that, as the title suggests, there's multiple downsides to this. So this stock is like a 200 million market cap. Then their net cash, so the first downside is the net cash is 180 million. So the actual is probably like 40 million plus. So that's the first downside. Second downside is, of course, the dividend yield. The third downside that can protect the share price is they announce a very aggressive share buyback. So they have like 45 million share buyback, which is huge. I mean, Starhub announced 50 million. So, but this guy's so small, but he announced 45 million. Maybe Starhub should follow them because it's like 10 times bigger. But they still have another 30 million of shares to buy. So 30 million worth of shares. So this is like 60 million of shares supporting 60 million of orders. I mean, not that they actually parked there, but the 60 million worth of orders supporting this share price because they are still buying at this current rate. Because there's a blackout, so they won't be buying now. But and the fourth reason is because after falling for 4 years, they announced, they seldom announce, but they announced they got 4 new customers. So this will also support the earnings. So that's why we rarely do, or at least I rarely do small cap, but this one looks interesting because there's a lot of downside protection. Upside is, upside you can never be too sure, but at least your downside is covered because there's buybacks, there's dividends, there's new customers. So this is going to be the last slide for us. I think we'll move on to conclusions, and then as usual, we try to leave half an hour for Q&A. So just to conclude, the first one is that we are very worried of the US economy because all this is spurred by fiscal deficits and credit card. Of course, you will say, they can continue spending, but the politics has changed a bit. I think you saw the speaker has moved. So the politics of austerity has come back it's always never been there, but I mean, it's come back again to the US. So this politics of shutdown, of not tightening budget has come back to the US. So the landscape has changed a bit. So the ability for the US government to spend may change because as we are entering the election cycle and the recent events recently, there's still a lot of drag. So we're worried of 2024. There's a drag from, I think we mentioned the COLA, the excess savings. We're still cautious on Singapore equities, and that's why we are anchored in dividend yields and a bit more non-cyclicals like telcos and so forth. So I'll just move on to the last one is the community slide, and then we can move on to this is our research team. So do ask them for questions. Next slide. Then next slide. This is our app. So this is where sometimes when the analysts go for meetings, then we will also mention some of the key things that has happened in the meetings. So you have time to do join the app. I think I'll move on to Q&A. I'll hand it to Roshan. Thanks everyone.